Inflation cooling down in the U.S. remains a hot topic among stock market investors as Federal Reserve continues to fight a battle against rising prices in the U.S. The next set of US CPI data for September is scheduled to be released on October 13th. Until then, uncertainty abounds. This is how the U.S. inflation rose and fell over the last few months. From 8.6% in May, U.S. inflation rose to 9.1% in June and later fell to 8.5% in July before settling at 8.3% in August 2022. Market-implied inflation expectations for the subsequent 2 years have fallen from as high as 4.9% in March to roughly 2.3%, suggesting that traders believe price pressures would decrease closer to the Fed's objective, theoretically paving the way for a dovish policy turn. Welcome to Savvy Economist. Today we would be looking at the recent propensities of slowing inflation. From earlier this year until just recently, every news pointed at high levels of inflation, but suddenly there is news of slowing inflation. Let us dive deeper into the topic to throw more light on the situation. Don't forget to hit the like button, subscribe, and turn on notifications.
It's naive that many market participants think that, there will be the big U-turn and the Federal Reserve will end tightening, will start QE again, aggressively lower rates. That's not going to happen. Yeah, I mean they're kind of in the corner because obviously inflation is the topic. So I think anybody who expects something like a U-turn like in 2018 will be very disappointed.
Yes.
My take has always been, and that was actually the title of my keynote last year here, it was called the monetary tipping point. And I made the case saying that actually we should focus less on central banks and we should focus more on fiscal stimulus. And I think for the next pivot, and I think that's really for financial markets in general, but also for gold, I think fiscal stimulus will be the most important driver.
Yes.
Now, when it comes to the Federal Reserve, I think everybody looked at Powell's speech in Jackson Hole, which was equity markets didn't like it. However, there was a speech by Lael Brainard, the vice chair, that was quite dovish from my point of view. And I think it's really worth watching. And she didn't give a speech since April. So that was the first one since then. And then there was another one by Williams, Fed New York, which was also, from my point of view, it kind of told me that they're, very close to where they want to be. And from my point of view, of course, this week, the CPI print came out and it shocked markets.
Yeah.
US equity markets were down 4%.
Right.
Just to give you one number, 1.5 trillion were wiped out in US equity markets. Mm-hmm. So that's the GDP of South Korea. So really, really big move. But I still think that over the next couple of months, we will see falling inflation rates, especially in the United States. In Europe, that's a different story. But from the indicators that I'm watching, inflation expectations, what the market is pricing, if you have a look at inflation-sensitive equity sectors, I would say it's more and more telling us that disinflation is the name of the game. For this CPI print, I think it was mostly affected by the housing market, by rents, which are very much of a lagging indicator. So I think over the next couple of weeks, we will see that inflation rates will come down dramatically. This will give central bankers some leeway. They will say, well, Jay Powell, I'm the new Paul Volcker, I killed inflation. We can step on the brakes. So that's kind of my scenario for the next couple of weeks.
This is an unusually challenging moment for the global macroeconomy. Who would have believed, even a year or two back, that US inflation would be at 8.3%, that Euro area inflation would be at 9.1%, or that UK inflation would be at 9.9%? Who would have thought that major central banks would be raising interest rates at the fastest pace in a generation? Or that the euro and the British pound would be at parity with the dollar? Just over a decade ago, it was common to talk about a great moderation in global macroeconomic conditions. Mervyn King, a former Bank of England governor, called it the nice period, an acronym for non-inflationary, consistently expansionary. Today it would be more appropriate to talk about vice, a volatile, inflationary, and contractionary economy. This regime change in global conditions was reflected at last month's Jackson Hole Economic Policy Symposium, an annual gathering of central bankers hosted by the Kansas City Fed of the U.S. Federal Reserve System. The theme of this year's meeting was reassessing constraints on the economy and policy. Given the humbling economic developments of the past year or so, the tone of the discussion was very different to that of previous occasions. No longer were we talking about the challenges of low inflation, how higher debt levels are sustainable if interest rates are low, or the social benefits of running economies hot. Instead, there was a broad appreciation that macro policy settings had been far too loose in 2021, contributing to high inflation rates and with them, a cost of living crisis. Everyone recognized that exogenous shocks, including Russia's war in Ukraine and supply chain problems, had accelerated inflation. But expansionary policy settings had left the system highly exposed to these supply shocks. Just as with supply chains, running the economy hot to achieve slightly better short-term results came at a high price. The system then failed under stress. Fortunately, there has been pragmatic recognition of the problems and a willingness to change course. At Jackson Hole, Chairman Jerome Powell invoked the legacy of Paul Volcker, who decisively stabilized inflation after the policy errors of the 1970s. His point was very clear. The Fed will do what it takes to bring inflation down and to keep it down. Nobody would choose to play the Paul Volcker role. It would have been much better if the Fed had not fallen behind the curve, letting inflation get out of control. But now the course has changed. The approach needs to be about disinflation. Economists polled by the Wall Street Journal predict consumer prices declined by 0.1% in August. If so, the yearly rate of inflation could slow to 7.9% from 8.5% in July and 9.1% in June. The June reading was the highest since 1981. Falling gasoline prices could also curb inflationary pressures in September and October. Crude oil prices have declined and gasoline demand usually tapers off at the end of the U.S. summer driving season. So the Federal Reserve should be prepared to back off on plans to sharply raise its benchmark short-term interest rate at its policy meeting in late September, right? Not so, economists say. Fed officials believe inflation is starting to slow, but they are worried about a broadening of prices pressures to a wider range of goods and services over the last year that encompasses most of the economy. The cost of fuel, food, rent, housing, cars and trucks and many other goods and services have risen sharply, and there's not much relief in sight. A separate measure of consumer prices, known as the core CPI, underscores the point. The core rate, which excludes volatile food and energy prices, is likely to rise another 0.3% in August. As a result, the yearly increase in the core inflation rate could move higher to 6.1% from 5.9% in July. That's more than triple the average annual rate of inflation in the decade before the coronavirus pandemic. The Fed views core inflation as a better tool to determine where inflation is headed. And right now, Fed officials see price pressures as still far too high. The rate helps determine the cost of borrowing for credit cards, mortgages, auto loans, and business loans. Higher rates slow the economy and can even trigger recessions. Wall Street leans toward the view that the central bank will raise the rate by another 0.75 percentage points to a range of 3% to 3.25%. Just 7 months ago, the rate was near zero. But a particularly soft CPI report could sway the Fed to lift rates by just 0.5 percentage point, some economists say. If the cost of food and rent, for example, came off a boil in August, the Fed would have more reason to go easy, they say. Yet economists who believe a bigger rate hike is baked into the cake point to the scorching labor market as sufficient cause for the Fed to stay aggressive in its policy. The U.S. added a robust 315,000 new jobs in August, for instance, and new unemployment filings fell in early September to a 3.5-month low. The tightest labor market in decades is driving up worker wages at a 5% plus annual pace, the fastest since the early 1980s. The Fed is worried that rapidly rising pay could add to inflation, making it harder to get prices back under control. The labor market is still overheated, and core inflation is still increasing at too high a rate, said U.S. economist Alex Pell at Mizuho Securities. In the short run, even falling gasoline prices might not make the Fed's job much easier. Americans will have more money to spend on other goods and services, keeping the economy and labor market growing faster than the Fed would like. The Fed needs to see growth slow, not accelerate, said Chief Economist Annetta Markowska of Jefferies LLC. South Korea's consumer inflation slowed for a second month in September, but economists said the data would do little to change the central bank's tightening bias amid growing talk it could opt for a bigger hike next week. Since March, the U.S. central bank has hiked its policy rate from near zero to the current range of 3.00% to 3.25%. Last week, the Fed raised its median forecast for core PCE inflation to 4.5% this year from its previous estimate of 4.3% in June. Its estimate for core inflation in 2023 was boosted to 3.1% from the previously projected 2.7% in June. High inflation is cutting into spending. Inflation-adjusted consumer spending edged up 0.1% in August after dipping 0.1% in the prior month. That suggests consumer spending could be tepid this quarter after helping to blunt the drag on gross domestic product from a slowdown in the pace of inventory accumulation in the second quarter. Consumer spending increased at a 2% annualized rate in the second quarter. The economy contracted at a 0.6% pace last quarter after shrinking at a 1.6% rate in the January-March quarter. Goldman Sachs cut its third-quarter GDP growth forecast by 0.5 percentage points to a 0.9% rate on the spending data. Growth this quarter is seen driven largely by a narrowing trade deficit. An accumulation of inventory, part of its unsold goods because of slowing demand, is also seen supporting GDP growth this quarter. The near-term outlook remains modest at best, said Scott Hoyt, senior economist at Moody's Analytics in Westchester, Pennsylvania. Rising interest rates will make new borrowing more expensive, undermining spending on big-ticket items typically bought on credit. Consumer spending is likely to remain moderate, with wage growth showing signs of slowing. Personal income rose 0.3% in August, matching the prior month's gain. Wages increased 0.3% after surging 0.8% in July. The saving rate was unchanged at 3.5%. July's saving rate was slashed to 3.5% from the previously reported 5%. The saving rate was as high as 26.3% in March 2021. It is now near levels seen during the 2007 to 2009 Great Recession. It looks like consumers have been eating into the excess saving built up over the earlier stages of the pandemic to fuel recent spending, said Daniel Silver, an economist at J.P. Morgan in New York. In any event, Europe faces an energy crisis that is worsening, even though natural gas prices fell sharply in recent weeks. The decline in prices came about the following news that Germany had been more successful in stockpiling gas reserves than previously expected. Still, gas shipments from Russia remain very low and uncertainty continues regarding Russian intentions during the coming cold winter months. Meanwhile, with Russian shipments down, Norway is now the biggest supplier of gas to Western Europe. In addition, the extremely high temperatures this summer resulted in increased demand for electricity combined with lower water levels. The latter limited the ability to generate electricity from nuclear and hydroelectric plants and limited the capacity to ship energy commodities on inland waterways. Interestingly, it is the fear of even higher energy prices that have fueled a sharp decline in the value of the euro, despite increasing expectations that the ECB will tighten monetary policy further. It is reported that the volume of investor bets against the euro has surged lately. Investors believe that a likely further surge in energy prices will fuel accelerated inflation. All other things being equal, if inflation is higher in Europe than in the United States, it will lead to a decline in the euro versus the dollar. Currently, the euro is roughly at par with the dollar for the first time in 20 years. Disinflation only shows that there has been a reduction in the speed of inflation, not its cessation. Although this disinflation can only be seen in certain regions and sectors, some like the Eurozone still show high inflationary rates. As we go into the cold winter months, we are likely going to see the government make policies to try and curb the energy crisis. Will things end up being a major disaster during these last few months? Or would a miraculous policy provide a soft landing? Let's know what you think and how you are preparing for the winter months. Don't forget to hit the like button, subscribe, and drop your comments below. Thanks for watching.